There was a time when $1,000 was all I had to my name. Not inherited money, not borrowed capital, just the result of my own speculation, hard-earned through studying the market and losing enough to understand what not to do. That $1,000 became the foundation for a fortune, not because I found some secret system or lucky break, but because I finally learned how to build on success instead of destroying it. That was the real turning point. I didn't make the big money by being right once. I made it by being right, and then pressing that correctness at the right time. Most traders never understand that principle. They treat every trade the same, whether it's a small opportunity or the start of a major move. They scale in when they should be scaling out, and they add to losers while cutting winners short. That's why they fail. The idea of pyramiding, of building a position as the market moves in your favor, is one of the most powerful, misunderstood, and dangerous weapons in speculation. Used right, it turns a small capital base into a fortune. Used wrong, it wipes out even the strongest operator. When I began trading with that $1,000, I had already gone through enough failures to know that I couldn't afford to gamble. I wasn't interested in being right. I was interested in staying right. I wanted to catch a trend and ride it, but more importantly, I wanted to pyramid into it correctly. That's the difference between a lucky win and professional speculation. Let me explain what most traders get wrong. They add to a losing position. They buy more when the market moves against them, thinking they're lowering their cost. They tell themselves they're being smart, getting a better average. But that's not smart. It's suicide disguised as patience. The market is showing you that you're wrong, yet you choose to argue with it. Adding to a loser is like trying to put out a fire by throwing more gasoline on it. I never added to a losing trade. Not once. When I pyramided, I did it only after the market proved I was right. That's the entire secret. Wait for the market to confirm your judgment before you commit more capital. In that particular campaign, I started with my small $1,000 position in a stock that had just broken out of a long base. The tape was telling me accumulation had been taking place, strong hands were quietly buying, and the public wasn't paying attention yet. I bought my initial stake, small and cautious, with the understanding that I might be wrong. I placed a stop just below the recent low because if the stock fell back into that range, it meant I had misread the signal. At first, the market did nothing. It hesitated, drifted, almost testing my nerve. Then, one day, the tape began to speed up. The bids were firm, the offers thin. The stock moved upward with authority. That was the confirmation I had been waiting for. Most traders at that point would just sit and watch, satisfied with being right. But I had learned that the real opportunity begins after the first proof. When the market confirms your position, that's your green light to build. I added to my position not recklessly, but systematically. I didn't double it all at once. I added in steps, each time the stock made a new high after a brief consolidation. Here's what most don't understand. Pyramiding is not about adding more because you're excited. It's about adding more because the market is telling you the trend is strong. You only add when the stock moves in your favor and confirms strength, not before. And each addition should be smaller than the previous one. That's how you stay safe, even in a powerful move. If your first trade is 1,000 shares, your second might be 700, your third 500, your fourth 300. Each addition costs you more per share, but carries less risk because it's funded by profits. That's the secret, using the market's own money to build your fortune. In that campaign, every time the stock pushed higher and held its ground, I added a little more. My average cost rose, but my risk decreased. Why? Because the stock was moving in my direction, and I was only adding after it proved its strength. My stops were trailed upward, never widened. The moment the market reversed and hit my protection level, I'd be out with a large profit, not a loss. That's how a small beginning turned into a massive position, not through greed, but through discipline, not by guessing, but by waiting for confirmation and using the market's energy to build size. You see, most traders think pyramiding is about being aggressive. It's not. It's about being precise. It's a method of compounding confidence only when the market agrees with you. It's patience multiplied by proof. During that campaign, I remember the feeling of temptation creeping in. The stock was running strong, and I felt the urge to go all in. The tape was flying, and I thought, if I double up now, I'll make a fortune. But that's when experience whispered, don't do it. The best pyramids are built on logic, not emotion. You add only on strength, never on excitement. Excitement is what ruins most traders. There's another rule to pyramiding that I learned the hard way. Never let your last addition turn your whole position into a loser. Every time you add, you must move your stop to a point that locks in profit on the earlier trades. That way, if the market suddenly turns, you can be stopped out safely. Most traders forget this. They build size but leave their stop where it began. When the reversal comes, and it always comes, they lose everything they built. Pyramiding only works when you're as willing to cut as you are to add. The market rewards flexibility, not stubbornness. When that position finally ran its course, it didn't end with fireworks. It ended quietly, the way most great moves do. The tape began to show signs of exhaustion. Volume spiked, but the stock stopped advancing. The public started buying aggressively. That was my cue. When the crowd rushes in, it means the professionals are getting out. I began liquidating into strength, selling my pyramided position piece by piece. By the time I was completely out, the market started to reverse sharply. My exit was nearly perfect, but it wasn't about luck. It was about reading behavior, not price. I wasn't trying to pick the top. I just knew the rhythm had changed. That entire campaign, turning $1,000 into over $100,000, was not a miracle of prediction. It was the result of patience, discipline, and the correct use of pyramiding. Most traders lose because they want to make big money on small moves. They try to build positions before the market proves them right. That's like trying to build a house before you've laid the foundation. The true beauty of pyramiding lies in how it forces you to wait. You can't pyramid successfully unless you're already winning. You must earn the right to increase your risk. Every additional position is a reward for correct judgment, not a gamble to recover losses. And here's something most never realize. Pyramiding doesn't only multiply profits, it multiplies emotional control. When you see a trade move in your favor and add intelligently, your confidence grows naturally. You stop fearing the market because you're aligned with it. You're no longer fighting its current, you're riding it. But the moment you add impulsively or against the trend, that same principle works in reverse. Fear grows faster than profits. You start hoping instead of thinking. Hope has no place in speculation. I remember another trader watching me pyramid into that winning position. He said, "Aren't you afraid of losing it all?" I told him, "I'd be afraid if I was guessing. But I'm not guessing, I'm obeying the market." That's the difference between confidence and arrogance. Confidence follows proof. Arrogance acts without it. If you want to master pyramiding, understand this. It's not a method for beginners. It demands a deep respect for risk and an iron rule of discipline. You can't pyramid on emotion, and you can't force a move that isn't there. You must first learn to take small, clean profits and small, clean losses before you ever think about scaling up. The reason most traders fail at pyramiding is because they try to make up for lost time. They think adding size will make them rich faster. It won't. It'll only destroy them faster. The purpose of pyramiding is not speed, it's efficiency. You're letting the market do the heavy lifting. When I look back, that single campaign taught me more about myself than all the losing years combined. It showed me that success in speculation isn't about brilliance, it's about temperament. The market rewards the trader who can wait, who can add only when right, who treats profit as carefully as capital. That $1,000 didn't grow into $100,000 by chance. It grew because every dollar I added was justified by proof, not by hope. Each layer of that pyramid was built on confirmation, not emotion. And when it was time to sell, I sold without hesitation. The key to pyramiding is not only knowing when to add, but also knowing when to stop. So, if you ever want to build real wealth in the market, remember this. You don't have to be right often. You just have to be right big when you are. And when you are, you pyramid intelligently. You let the market pay for your risk, and you never, ever add to a losing trade. The market will always test your nerve. It will reward patience and punish pride. But when you finally learn to build your position the way a craftsman builds a structure carefully, step by step, only on solid ground, you'll see what few ever see. How a small beginning, guided by discipline, can grow into a fortune. That's not a fantasy. That's the quiet, unglamorous truth of every great operator who ever lasted long enough to tell his story.